Yes, welcome. I hopefully everybody sees this. It will start in 3 minutes. Yes, I thank you. I hopefully there will not be any glitches. Um, as I've noticed, there is a little bit of delay. So when you're going to write your questions, if you have any questions or so on, it probably will take some time before I basically answer. But I'll. This is the first video or live stream, so I'll try to fix all the bugs for next time that I see. Yes, so we are going to start. So welcome. Um, it's going to take roughly 1 hour. So I've put 1 hour aside for this. And as this is the first live stream, and it's going to be a course where we look at how you use technical indicators when you're basically trading, I will do the most basic technical indicators. Um, as most traders that are on Patreon also use eToro, so I just chose that platform, even though it's not the best platform in the world. It is a very easy platform to use. It has its advantages and it also has its major disadvantages. So this is the main screen in the eToro platform, and of course if you're a trader that wants to hold your trades for example, a few seconds and for probably a few minutes with very high leverage and so on, this is definitely not the platform you should be using. And the main reason for that is because it just takes too long in order to execute a trade on eToro. In other professional platforms, for example, TC2000 or others like that, you can basically click one button in order to buy and click another button in order to sell, and it does that instantly. Here you have to do all kinds of things in order to execute your trade and so on. Mainly, you have to click several times, and sometimes it's also very buggy. So the reason why my trades are for hours, days, and weeks is basically due to the fact that I'm trading on this platform. I have to adjust my trading to what this platform can provide. But there are other things that are really good, and it's a really clean platform. And for example, this main platform here has some major advantages. For example, this 52-week range. I use this all the time. It is very similar to an RSI, or what an RSI tries to explain to you. So here you have an indication where the price, the current price, is compared to the last 52 weeks. And if this arrow here is way at the top, it basically means that there is a lot of a lot of buying pressure, and it's probably overvalued compared to the last 52 weeks. And that is very similar to what RSI is doing, where we look at a daily basis. This is just for the last 52 weeks. So, for example, if you look at the US dollar, it is very, very weak and very oversold at this point. So it's actually, you can also say it's very cheap. While if you look at copper, which has just been increasing and increasing constantly, it is way overbought, and at this point it's very overvalued, you can basically say. Then you also have the sentiments. They are helpful, but I don't use the sentiments when I trade. I look at it and say, okay, that looks interesting, but the sentiments are just based on the sentiments on the people that are using eToro, not for a bigger trading audience. So they are limited. If they were basically several sites that had the same sentiment, then there would be much more useful. So I think that sentiments, for example, on investing.com are more helpful than the sentiments on eToro. But we'll start by looking at the charts. And the charts are okay. They're not fantastic. They're not terribly bad, but they're okay. So there are two ways of entering the chart. You can basically go to one of these instruments, for example, oil, and then you could click on the chart. I tend to use the more advanced chart, and that you can enter by just clicking on this chart here. So just do that. So So when you get to this chart and you haven't added any technical indicator whatsoever, you're just left with the pure price action of in this case, of oil. So we are in the daily chart, and the reason and the way you can see that we're in the daily chart is that you have 1D here, and that's basically 1 day. And all of these candlesticks here represent the price action of a given day. So red candlesticks, they represent that the price is lower this day than the previous day, while a green candlestick represents an increase in the price compared to the previous days. So you have green and you red. And then you have, for example, if you just scroll into the period that we have now, we can see that something like this. If you look here up in the corner, you have a pen, and in this pen you have all the tools, all the technical indicators, and all the functions that eToro has available. And you can also change the candlesticks. I like them as they are right now, but you can see other candlesticks from other analysis that are looking a little bit different like this than this one. So if you want to change the candlesticks, you can go under here, the candlesticks, and you have the different kinds of candlesticks and also lines and so on. But the most common candlestick are the full body candlesticks and so on. So these are the ones that I use because they are far more visible than the other candlesticks. So if you click on this pen, the first thing you will be shown are the tools. So within the tools, you have the measurements, channels, and so on. And then you also have the horizontal and the vertical axes. So I don't use the vertical much, but I use the horizontal all the time. And then I also use the Fibonacci all the time. And then there is another one here, which is a thicker bar that I also use when there is a big there's a big price action of support or a price action of resistant. But my entire trading strategy is based on checking where we have the high points and where we have the low points. So the horizontal bars, if you click that, we can see that the highest point in this range is here. So this is 2 days ago, where we hit 46.6026. So the reason why that is important is because when price action gets close to this area again, for example, today we have a little bit of an increase in the price of oil, but we're not even close to the very highs. But when we get close to the very highs, there were two things will happen. Either it will be rejected, that means that we are going to, the price action will fall again, or we will basically pierce this these very highs and then we'll go higher. The third thing is that you basically pierce and then you go lower. But in most cases, when you basically pierce these highs, the very highs, it is a signal that people are buying and it will go higher. An example of this is what happened here. It's only 3 days ago. So the previous highs were over here. So this is way back in August. So we have August, it's basically end of August, where price hit the very highs here of 43.84. So we can see what happened here 3 days ago, that we rallied. If we had crossed all the way up here and then broken it down again, that would be an indication that this was a significant resistant area that was still holding. But that was not the case. We broke through this resistant area and then rallied significantly higher until we hit the next resistant. So at this point, this is no longer resistant. The next time price action comes down, this will act as support. So just keep that in mind. That's the reason why I target some of these price levels, because I don't expect price to go lower than this. If it goes lower, then it goes significantly lower. Similar to here, like we broke through and then went significantly higher. The opposite would happen here. The thing that I think will happen here is that we will rally, we'll break down again, and probably hit the 43.84 level and then continue higher. That is what I expect is going to happen. As you can see, we are rallying a little bit in oil today. Quite okay. It's like around 1% higher today. But when we get to these price, we need basically to crash through this very high here in order to go significantly higher. Otherwise, we'll just turn around and go and head back towards this price action. So that's, I think, the most simplest way to look at how you can basically trade is by looking at the very highs and the very lows. So the very lows here are down here. They are far, far, far away. So we can see that they're 33.77. That is the very low of this range. So that could mean that we are just basically at the top of this range. We could be heading all the way down to this price action again. That is plausible because these are the very lows and these are the very highs. If we continue up, for example, to 37.5, which I think we are going to go to before we go significantly lower, we'll probably also go to 50 before we go significantly lower. So we may see something like this, a turnaround towards the previous highs and then go up again towards the 37.5. And then we technically see what will happen. at that point, other things come into effect. For example, is it overbought? Is it overvalued? And so on. I would say it is at this point overbought and overvalued, and we could expect this to fall significantly. The main reason for most of this price action here was based on, for example, vaccine news. But vaccine news doesn't increase demand for oil. So when the markets start to wake up and see that even though we have good news on vaccines and demand is still low, then there will be a very negative sentiment for the price, and it will continue to fall. So that's what I expect is going to happen. That will just take some time. You will get the reports on the storage and so on, and they will see that the change in the storage isn't that much. There still isn't that demand there. So these are the horizontal bars. This is what I use technically all the time, just to see where the market is and where it will go. And then, of course, you have all of these smaller tops here that also will act as resistance and support. So if I were to add several layers of lines, I would add one here as also as resistant if prices go down. I would also add these previous lows here as also as resistant, and of course this as support, and this as a major support. If this breaks, then we are going all the way down to 30. But at this point, that is quite far away in the future. So the way that you would delete these lines is that you right-click on the line and they vanish. So the first thing on our list, the first indicator or method that you can use is the moving averages. So these are the most common technical analysis tool that you will ever use. And the way you put them on the screen, you basically go to this pen here, and then you have the tools, you have studies, and you have to go down towards study 2. So in study 2, you have, for example, the MACD, you have the median price, and then you also have here the moving averages. And we will click the moving average, and then you'll have another screen here that will pop up. And at the top of this list of indications is basically 50. And this is basically default because the 50 moving average is the most common moving average. So it is what all traders use. That is always on their screen. So we'll leave that as 50 because we're going to use that. Down here, you can choose the type of moving average. So there are many types of moving averages. For example, there's a simple, it's also called the normal, which we will choose for the 50. And then you have, for example, the exponential moving average. And then you have other moving averages that I very rarely use. Used to use in a university, but not now. I don't see them as helpful anyway. So I choose the 50 and the simple, and you can choose what color of the moving average you want. I choose red for the 50 moving average. So create, and then you get this line. So the way that the 50 moving average is calculated is that you have to have time series of 50 days in order to get 1 day of moving average. So it's basically the average of 50 closing prices in days. And the same goes for the 200 moving average. That is basically 200 days of price action that is averaged down to, and so on. So that's how you calculate these moving averages. And that's also the reason why some of them are above and some of them are underneath. And some move faster and slower depending on how high the moving average is. For example, the 5 moving average will move significantly faster than the 50 and so on. and that is helpful depending on what market you're in. If you are um, trading instruments that move really fast, then it's helpful that you have moving averages that are very low. And it's also helpful that you have exponential moving averages because they move even faster than the normal ones. So the 50 moving average, just by looking at it, you can define when you have a bullish market and when you have a bearish market. So every time price action is above the 50 moving average, we have a market that is increasing in price. So that's a very simple term how to identify whether or not a market is growing. Is basically if it's above, then it is most likely growing and increasing in price, and if it's underneath, then it is basically decreasing in price. So we see here, every time we get a candlestick that breaks, we get a price action that increases all the way to the top, and then it breaks again. So when it goes underneath the 50 moving average, and it starts to decrease. For example, here, this is the beginning of the coronavirus, the price war between Saudi Arabia and Russia, and also the massive supply that was available of WTI oil. And those three things were basically the combination that led to this massive fall. So it's just not just the coronavirus, it was also the war between Russia and Saudi Arabia, the price war, and also the massive amounts of supply in the market. So it is also very helpful to click on this cross here, did mention that, and that shows you the date down here where we are, and it also shows you the price action over here. So that is the reason why we fell in the oil prices. There is no price war at this point. Coronavirus is coming to an end. It will still last for several more months, but and the storages are not as full as they were back then. So we are in a completely different market now than we were back in this area here. But you can see that the distance between the candlesticks and the 50 moving average is also very important. The further you are away from the 50 moving average in price action, the more oversold or overbought you are. For example, right here, the distance between this candlestick and the 50 moving average is quite substantial, and that is an indication that prices are fairly oversold, or this instrument is fairly oversold and it is very cheap. And then you will basically see buyers come in, buy it up because it is cheap. That's what we do. Until we get close to the 50 moving average, and then they start selling again. And you can see right here how far the price is away from the 50 moving average. It's just enormous distance between these two. And therefore you have this massive rally, even though you have this gigantic fall in the price of oil, you still have this rally of around 13%, I think it was, in this area, in this massive fall. And also here, the distance between the very bottom of 7.35 to the 50 moving average is also significant. And then you get this massive rally. And the reason why you get this massive rally is because you are so oversold. It is so cheap that people are just jumping at this and buying. So this chart only shows 7.37, I think it's 7.17 as the lowest price in this period. For other futures, they basically became negative. So it doesn't show on this, but they became negative. I think it was negative $35 or $37. It was quite extreme. So we rallied again. We crossed the 50 moving average here in the end of April, and this signals that this market is going to increase in price. And we did increase from the beginning, the end of April, all the way to the mid of August when we hit these previous highs. So even though we were mainly flat on this entire period here, this is still significant growth because we crossed the 50 moving average. So just keep in mind, when we cross above the 50 moving average, expect prices to increase. When prices cross underneath the 50 moving average, expect prices to fall. And this is what we do all the time. So if you look at the period that we're in now, we can see that we crossed the 50 moving average around 3 weeks ago, and we have rallied ever since. So it's not going to be until we cross the 50 moving average again where you can basically expect prices to fall on a daily basis. For example, we have a good example here. We cross the 50 moving average and then we get 3-4 consecutive days where prices just collapse. The same goes for here. The same goes also here. It is not realistic to expect prices to behave this way when you are above the 50 moving average. You're expecting prices to increase, for example, be green, not to be red. So at some point we will catch up with the 50 moving average like we always do, but what we're doing now is not expecting a complete collapse. It's not something like this. We are trying to catch these previous highs, if that is possible, because we are overbought at this point. So the other moving average that is very common is the 200 moving average. And most of the time, I only use those two moving averages. So if you click the pen again and then go under study, you can just click the moving average again, and you can add as many moving averages as you want. But a very good idea is in the beginning not to have too many moving averages. It's also a good idea not to have too many indicators. And in the beginning, when I started trading, I just chose all the indicators that I basically could find. And the only thing that did was basically confuse me more. You need to have it as clear as possible and the screen as clean as possible. That's what I found was the easiest way to trade, just to use the simple things. So if you click the moving average, you can press, instead of having 50, you write 200. And we are still in the simple moving average and not exponential. And you can choose another color, for example, blue. And then click create. So now we have the 50 moving average as the red one. We have the 200 moving average as the blue one. And the reason why these two moving averages are so significant is because of their crossing. So every time these two moving averages cross, there is most usually, a significant move in the market. Not always, but most of the time. So the crossing, for example, here, and also back here, and over here, those crossings are called golden crossings. So we can pick up some of these big moves. For example, here is a crossing, and you can see right here you have this massive spike to the upside. Then prices fall again, and our second crossing here is right here. That is basically around the top of this price action. So just keep in mind that all of these indicators and tools are lagging. So they're lagging indicators. They don't show what will happen, show us in foresight what will happen. They show us basically afterwards that prices start to fall, what will happen. For example, here, prices are already starting to fall, and we'll take, for example, 2 trading days for these two moving averages to cross. So just keep that in mind. They are helpful, but they are lagging. So you see that we have a crossing here and we just fall off a cliff. Then when prices increase again, we have another crossing here, and prices again fall off a cliff. So the next time we have another crossing, I don't know when that is going to be. Sometimes it's only a matter of weeks. Sometimes it's a matter of months. For example, here, this was the end of February, and we had another crossing here at the beginning of September. So nearly half a year was in between these two crossings. While here is beginning of January and the end of February. So depending on how volatile markets are, these indicators will basically also be crossing at the same rate. But the 200 moving average is often very significant when it comes to support and resistance. We can have some example of it here. For example, here the price action is bouncing off the 200 moving average, which is very common. We also have indications of it bouncing downwards. For example, here it hits the 200 moving average and then bounces down. So both the 50 and the 200 moving averages are also indicators of where there is going to be resistance and where there is going to be support. If we take the 15 moving average again, we can see that in this period here, it is trading above the price action. And when we get close to the 50 moving average, for example, there, it bounces. And these are indications that prices are not ready to cross the moving averages. When we have candlesticks that basically bounce like this, expect markets to continue to climb. While you have in this period here, when you have candlesticks that go straight through the moving average and don't bounce or get rejected to the downside, this is a clear indication that price action is about to change and we are going to the upside. So that is both for the 50 moving average, that is also for the 200 moving average, and that's also for other moving averages. But these are just most common ones that I also use on a daily basis, especially for stocks, for commodities, but not for Forex. For Forex, I use a lot more moving averages, especially the 40 exponential and the 20 exponential. As you can see on my videos, I use that, for example, also on TC2000 when I do my trading. So next on our list is the MACD. And then we'll look at the RSI, and then we'll go and look at some example of trades for today. So in order to get the MACD, we go back to this pen tool here. You can go to Study, or Study 2, and on the top of this list, we have the MACD. So if you press the MACD, we get this chart here. So the MACD is a momentum indicator. It basically shows whether or not an instrument, it's a stock or a currency or a commodity, whether or not that is increasing in price or decreasing in price. So there are two moving averages within the MACD. You have the 12 period moving average, and then you have the slower 26 moving average. And the reason why it's called a slower is because there's just two more moving averages. So the lower this number is, the faster it moves, as I said. If you have a 5 moving average, that will move significantly faster than a 50 moving average. So, and because these two moving averages are different, they will cross. And it is those crossings that are indications where prices will become bullish or prices will become bearish. So if you click the create button, you get the two moving averages. You have the black one and you have the red one. So the black one is the 12 moving average, and the red one is is the slower one. So we also have this histogram here, and the histogram shows the distance between the two moving averages. So the further these two moving averages are apart, the bigger the histogram. And it also shows whether or not you have positive days of price action or negative days of price action. So you're still going to have, for example, days where prices are bearish, where price action is going down, but still have a positive day. And when we are underneath, for example, 0, then it is very bearish. And when we are above this 0, we are bullish. So just keep that in mind. These lines, when they are above, is bearish. When it's underneath, it is bullish, and underneath it is bearish. But the most important thing of the MACD is where these lines cross, because that is an indication of when we could expect a price shift. So, for example, here, this is back in the end of April, we have the black line crossing the red line. So crossing the signal line, or basically call it. And this is an indication that we are going to see a bullish move in this market. And that's also what we saw. So this is also a lagging indicator. It will not show what will happen in foresight. It will only show in what basically a lagging behind, for example, 1 or 2 days. So when it crosses here, we can see that we start our bullish move. And our bullish move doesn't end until we get to this area, right there. This is where prices start to become flat. There's almost no increase in this area here. And the MACD is also crossing the signal line. So it's not far away. They are not far away from each other. And we can see that on the histogram. There's a big difference between this histogram and this histogram. This is a far more bullish market here than we have here. It's also underneath the 0, and that also means that this market is basically flat or that it is bearish at this point. We have then we can basically focus in on this area. We have fairly crossing here, and you can also see that is a bullish sign that we are going down. We get the histogram starts to grow again, and we get a large sell-off, and we go all the way down from 43 down to $36. Then we have another crossing here. We start to increase, and then up and down, up and down. So the MACD is an indication of whether or not market is going to become bullish or whether or not a market is going to become bearish. That is what the MACD shows us. And the histograms shows us how far the moving averages are apart. And of course, the further these moving averages are apart, the less likely there is going to be a change. So that's how you should interpret it. The more distance they are apart, the less likely this market is going to change. So if we look at, for example, oil now, and we just look at the MACD. So I was not basing my trade on the MACD, and that's something I will come to later on. When you make a trade, you don't base your trades on only one indicator. You have to have all indicators showing that there's going to be a change, or you have a majority of your indicators showing that there's going to be a change. When I made my trade for the oil stock, or for oil, I was looking at these very highs, and I was also looking at other time periods or charts. For example, the hourly chart, the 4-hour chart, I was also looking at those. And I could see that there was a weakness in the market at this point, and therefore I decided it was a good idea when you had a massive red candlestick that this market will most likely continue downwards. So that's the reason why I chose to enter this market. But if you look at the MACD, it doesn't look like it is going to change anytime soon. It's still very bullish, but that doesn't mean that it can't turn around, as it is a lagging indicator. You can take a trade probably 2-3 days before the MACD will ever cross the signal line. So just keep that in mind. So the next indicator that we're going to look at is the RSI. So we'll click on this pen again. We'll click on Studies 2. And then you have to scroll down a little bit. And then you find the RSI. So the RSI in eToro is a little bit different than the RSI in other programs, and I don't know why they have this. I don't like it because the RSI, first of all, has a moving average of 14 days. So for the period of 14 days, but it is basically these overbought and oversold measures that I don't like. This is supposed to be 70. So when this line crosses 70, we get into a period of being overbought. And the other one is supposed to be 30. So just change those because that is a more accurate measurement of the RSI. So what the RSI basically tells us that it measures the momentum of the price. So similar to the MACD, it is a momentum indicator. So if the RSI is increasing, that means that people are buying. And if the RSI is decreasing, that means that people are selling. So it's basically it shows the demand in the market, whether people are selling or people are buying. And these overbought conditions and oversold conditions are technically the line where you say, okay, now too many people have bought this instrument and it's getting overbought. In other words, it's getting overvalued. And you should expect when things are overvalued for them to change. So people rationally don't buy things that are overvalued. If they see something that just has a crazy price, they just stay away from it, or in other ways, they try to sell it and so on, because they know they can make a big buck. And the same goes for oversold conditions. When things are oversold, it is an indication that too many people have sold and things are very cheap. And people like things that are very cheap. If you make a discount, you get more people into your stores compared to if you don't make a discount. That's why the stores make discounts. And the oversold condition is basically a discount. It shows you that you have a discount in the market. So if you click Create, you can see that we have this signal line here, and then we have the upper line, which is the 70 line, and we have the line down here, which is the 30 line. And every time we get below or above these indicators or these lines, it will show up as a dark area, which is really good. I like this feature in eToro when it shows these gray areas, because it's much easier to see when things are overbought or when things are oversold. So we can look at, for example, the most extreme. For example, here we can scroll back. This is all the way back in April. It is the 21st of April, and this is where prices basically fell to minus in the market. And on eToro, it shows 7.17 or something like that, the lowest. So this is a really good example of where you can use the MACD and where you can use the RSI. So the MACD is lagging a few days here, but the RSI is showing that we are in an area of oversold. So if you just take the bottom of this area, it's becoming gray, and you can see over here that it says 25. And 25 is way below 30, significantly lower than 30. We can also see that we are over here, we're also at 26, and we get a rally. We are 25 here, we get a rally, and so on. And that is how you use the RSI. You look at when this price is underneath 30, and the further is down below the 30, the more likely it is going to have a positive effect on price, and vice versa. For example, here we can see that we are at 75 and we are way overbought. And this is also where we have this drop. It's not a significant drop, but it is a drop. And that is due to the fact that prices are way too high. It is too expensive. So we can scroll all the way back here and look at areas where we can find overbought situations or oversold situations. For example, here is the most recent one. We're at 25 again. It is basically here. It took a few trading days until we rallied up towards 41. Then we can see over here, this is the very recent one. We are at the top here due to this massive rally. And the prices at this point, or the RSI at this point, is at 72. So this is a clear sign of a market that is overbought, and you should expect this market to fall. And that's also what we saw the next day. It fell significantly. So we're still at 67. We're not overbought yet, but we are in that area. And therefore, yes, prices can increase, but I don't expect prices to increase so much that we will rally all the way to 50 at this point, because there just isn't that much room in the RSI. If it gets to 75, which it can do in one day now, it most likely will fall. And you can also see today, I would be very surprised if we break these highs at this point. We may, if we go sideways for a few days, then we basically can break to the highs. But at this point, we are getting rejected at the 35.62. So at this point, we are at 35.4, and we'll have to see. The MACD, I do expect will start to turn around within the next 2 or 3 days. And that could indicate that we will go at least to test these previous highs. So that's a drop of around $36.27 all the way down to $43.82. So that is how you use these two indicators. And the RSI was one of the indicators I used in order to determine whether or not I should enter this market for a sell, because I could see that it was overbought. But not the MACD, not in this case. Then we have the stochastic and the Bollinger Bands and the CCI and so on, the other indicators that I also use, but we will not have time to use all those or get through all those indicators today. We'll use them some other time. So what I'll do in the future is that I will add one indicator to the indicators, and then I'll show how you basically can use these indicators in sequence, because you never base your trade only on one indicator. You have to have around 3 indicators that are showing similar things in order to take action. So this is the way you should trade. This is the way you act as the casino and not as the gambler. if you just enter a market not looking at any of these indicators, for example, here is a classic example of people looking at this price action and thinking, okay, prices are going up. It's a fantastic idea to buy here. While other people that are trained in this, they will look at the RSI, they will see the RSI at this point is at 70, above 70. It is a terrible idea to buy it here. You should expect a pullback. You can sell that pullback or wait until you pull back all the way as far as to the 50 moving average as possible in order to buy in. So play the casino, don't play the gambler. That's how you should use the technical indicators. So I can look at some of the trades that I think are interesting today. And the first one is cocoa. I don't know how much this has changed the last time I looked at it. It's a few minutes ago, but it is still very negative. So the reason why I look at cocoa is because it is a typical of a very a market that it looks like a bubble. So it just exploded to the upside, and you got this very, very negative candlestick. And when I say negative, it's a candlestick that looks like a hammer, inverted hammer. So basically a hammer where the head is down and then the shaft is upwards. And this is a clear indication that you have an enormous amount of sellers coming in and pressuring this price down. And you also can see that the distance between the signal line, the 12 moving average and the 26 moving average is very, very significant. This is just a market that is way, way overbought. If you look at the RSI here, it was at 75 at the peak, right? 76 when it at the peak. So to buy when the RSI is at 76 is a really bad idea. And that is a clear indication here that this was a really bad idea. So at this point, I've said this several times in my video, I do expect this market to fall. There are several barriers. For example, these previous highs will act as support now. We have breached some of them, but not all of them. But I do believe that we'll go significantly lower. One of the indicators that you can use, which I can add now as well, is the Fibonacci. So if you click on the pen here, and then you click on Tools, and the first thing you can see here is the Fibonacci. So I can have a full course about the Fibonacci retracements and signals in the future, because there are several Fibonacci and they are much better on TC 2000 than they are on eToro. So click on the Fibonacci. So you can use the Fibonacci in two ways. You can take the top of a range to the bottom of a range. And when you do that, you are estimating how far a market will increase before it decreases again. So for example, here you could basically take the top of the range, click, drag it down, and then you would see these lines. You have 38, 50, and 61. And you can see that price action started to decrease again when we hit the 61.8%. That's around here. Perfect. So we got all the way up to that area and then it decreased again. So if you were back here, this was in October, you have the 50 moving average, which we basically hit. We had a decrease, found support in this area, and then we started rallying. If you had looked at this, you could have said, okay, I expect the price to go all the way up towards the Fibonacci retracement at 61.8. And you would be 100% right. So this doesn't work always, but most of the time it does work. And I can have another course why that is, because it's basically in the fabric of the world, basically. So if we look at the Fibonacci retracement for this trade, we can see take the very lows. You can take it here, but I choose to take it here longer. The further you are away, the better. And then you can drag it all the way up to the very top and then click. So here you can see that the first Fibonacci retracement is at 38.2. We would expect support here. If this breaks, then we'll go towards the 50. So if that breaks, that means that we're going to the 60, similar to what we saw here. We went to the 38, then to the 50, and then towards the 61.8. So that is basically one of the main reasons, also because we are overbought, that I expect this market to go towards the 38, then the 50, and in best case scenario to 61.8. So that's how you basically use the Fibonacci, and I'll make a course just about the Fibonacci retracement because it's one of the most powerful tools that are out there. So last but not least, I'll look at weeds. So this is a very good example of a market that has been bouncing off the 50 moving average for nearly 2 weeks now. And it has also done that way back in the past, all the way here, and now also recently. So it's going to be exciting to see what happens to wheat. If we bounce from here, then we'll target these very highs again. And that's a fairly good trade. If these highs break, then we'll go to the very highs. But these indicators are not looking very bullish for wheat. We're not overbought, not oversold. It is looking bearish because the momentum is downwards. The same goes for the MACD. It is not crossing the signal line and is also heading away from the other line. So we may go lower, we may stick around this area for some time, or we'll head to the upside. But of course, we only have 2 indicators here. The best thing that we're looking at this point is the 50 moving average. So at this point, that is what is holding. If it breaks, then we could drop significantly lower. It is we could estimate it fall towards 577. That is most likely where we'll head to if we fall, or towards this area here at 579. So time is nearly up. So I think that I don't know if people have any questions. You can write it into the chat. Nobody? So I hope you find this helpful. There's another online course not on the course, but I'll look at Mondays for live trades, and that is basically to show you what trades I'm looking at, both for stocks, for currencies, and so on, and that will basically be a build-up for the entire week. So on Mondays, because Fridays is quite difficult to say what will happen on Monday because most of the news comes out also on the weekend. But on Monday, you should have a clear sign of where markets are going to go that week. So we can look at specific trades and so on, what will most likely happen and where I will put my focus and so on. So that's what I'm going to do on Monday's session. And that is the same time. So good luck today and good weekend.